afternoon, everyone. Thank you so much for joining our webinar today. We'll just give it a few minutes before we kick off because we do have a lot of people who have registered. So in the meantime, I will be sending out a poll for you guys to answer, and I would love to see the responses. And we'll kick off at 12:05 with the content. So I'll send that out for you guys now.
Welcome, everyone.
So we do have a large number of people registered, over 300. So hopefully it's an informative session for you guys, and you guys can get a lot of information before the end of financial year, which is right around the corner.
It's creeping up. Hope everyone's had a strong 2022 financial year. And yeah, I'm sure you'll get a lot of value out of this webinar. We're going to go through some tax minimization and planning sort of things you can do prior to 30 June. And we'll run through some best practice things to do regarding your accounting and tax prior to 30 June, and then also some things to really set yourself up for the new financial year. And just while we're waiting, a sort of recent announcement was they've just made a change in New South Wales for the stamp duty, which is quite interesting, and making it, I think, optional for you to choose between a land tax or stamp duty, which is quite interesting. So obviously reducing the upfront cost to acquire a property, but then probably creating more tax if you hold the property for a longer period. I've done some rough calculations, and I think just with some really moderate land value increases, I'm sort of seeing maybe around the year 16, year 17 is when the land tax would be more favorable if you were selling the property in a short period of time. But if you're going to hold the property, I think paying the land tax is going to be more expensive, but then obviously it's a pretty significant upfront payment that usually you can't finance the stamp duty. So yeah, interesting news for New South Wales regarding the stamp duty for the land tax. Looks like it's gonna be more expensive, to be honest, if you're holding the property a longer period of time, assuming some moderate increases in the land value.
So welcome for those who are just joining as well. We're just going to wait until 12:05 until we have a few more people registered, who just to join in. But in the meantime, we have sent out a poll if you guys wanted to answer that, and we have received some responses. So it's great to see that we've got a wide range of companies and businesses, from customer experience, technology, sales and marketing here today. We have a few accountants join us as well, which is good.
Always good to get a couple of accountants. If yeah, and maybe you can just put your name and your city in the chat, just so we can see where everyone is based. Really interesting to see where you're all dialing in from. Okay, we got Perth, Sydney, South Australia, Brisbane. Wow, we've got quite a good range of attendees. Brisbane, Melbourne, Sydney. Excellent. So good to see people from so many different cities, and it's a bit of a testament to Lawpath really servicing businesses right across Australia and having that platform that caters for everyone, regardless of where your location is. Excellent. Sydney, Adelaide.
So just to answer a quick question, yes, you will be getting a recording of the webinar. We'll send it across to everyone who attended today. So we'll send that right at the end, including the slides. So if you're unable to make it until the end, you will get a copy.
Excellent. And if you have any questions, we'll do a Q&A at the end. So I'll go through as mentioned, for new people that have just jumped in, we'll do some tax planning and minimization tips prior to 30 June. We'll talk about some best practices to do for your business prior to 30 June, and also some things to set your business up for the next financial year. And for the Q&A, we'll do a Q&A at the end. So if you've got any pressing questions regarding the end of financial year for your business, would love to help and provide some guidance. So if you've got any questions specific to the content that we'll be running through, or if you've got any general questions, I'll do my best to get through as many of those as possible. So just feel free to add them to the Q&A, not the chat.
Okay, awesome. So it's 12:06, we'll get started. So welcome everyone to today's webinar. My name is Angela and I'll just be going through today's agenda and just some housekeeping. So throughout the course of the webinar, Pat will be running through some content, but as he mentioned, if you did have any questions, please feel free to pop it in the Q&A section, because as you guys can see, we have a lot of information in the chat and we don't want to lose the questions that are coming. So today's agenda will cover a bit of information about who Lawpath is and what we do, about Patrick, the best ways to prepare your business financially for the end of financial year, the top tax and accounting matters to consider, considerations for the new financial year. We do have an exclusive webinar offer for everyone who is joining today. And as I mentioned, any questions that you may have. So Pat, did you want to move on to the next slide, please? Thank you. So for those who have come to our previous webinars would know a little bit about Lawpath already, but for those who are joining us for the first time, welcome. I'll just give you guys a brief overview about who we are. So essentially Lawpath is your all-in-one business hub where you can access multiple tools to help your business. It is designed to provide you guys the tools that you need from a legal and business side of things. So this includes over 350 legal and business documents. You can sign your documents online with our e-signature tool. You can hire a lawyer online for a fixed fee and a booking consultations with your lawyer as well. We've got on-demand calls with a lawyer plus the accountant, which is Pat, our preferred accounting partner here at Lawpath. And also you can register a company, ABN and a business name. So I'll pass it over to Pat to introduce himself and we'll begin the webinar content. Thanks, everyone.
Awesome. Thanks for that, Angela. So I'm the CEO of Pop Tax and Pop Business. We're a chartered accounting firm. We're based in Sydney. We service businesses right across Australia. And yeah, been doing this for a long time, and I hope that you'll find a bit of value out of this content, which I'm sure you will. What I'll run through first is usually at the end of the financial year, we do a bit of tax planning for our clients. And if you haven't done this before, or if you're not sure what's involved, I'll just run through briefly what sort of happens at the end of the financial year. So what we do is we estimate the taxable income for the current financial year for your group, and that might be your company, it might be the individuals, the family members within the group. You might have a family trust and a bucket company. So whatever entities are involved in the group, we basically work out what we estimate the tax positions to be. We then look at strategies to minimize the tax. So that might be income spreading strategies across family members or other entities within the group. There might be things we can do from a tax reduction perspective, and I'm going to run through some of those, and that might be whether you're buying assets, whether you're topping up super, whether you're deferring some invoices close to the end of the year, whether you're using cash versus accrual basis, whether you're bringing forward some purchase invoices. There's just a whole bunch of things we can do. It could be dividends. Do we do dividends? Is there franking credits that can get refunded? There's honestly hundreds of things we look into, but what we do is we do a meeting to work out what your objectives are. And that helps align us to what tax reduction strategies we can do. And also understanding your objectives is really important, because we want to understand it's not just about reducing your tax, it's also about setting yourself up for what you're looking to do in the future. That might be getting your personal income up so you can get more borrowing capacity because you've got plans to do a particular financing arrangement for an asset. Could be property, could be, all sorts of things. So we do a meeting, we understand your objectives, we work out where you're positioned, we do a tax plan and work out what levers we can pull. So we do a base case scenario, and then we provide options, and you can select from the options within a meeting as to what, whether you do some of the options, all of the options, which will reduce your tax for the year. So that happens every financial year. It normally happens around May, June. So if you're a business owner and you haven't done that in the past, I strongly recommend you reaching out to your tax advisor. Really good practice, and in the future you'll definitely be way ahead, saving tax, which we all love doing. I'll run through the temporary full expensing first. And this is the guidance material from the Law Companion ruling 2021-3. And it's basically assets that you purchase. So for this financial year, if you have assets to purchase prior to the end of the financial year, so you might, there's still a little bit of time, but if you've purchased an asset previously as well, this is just good guidance. You can depreciate the asset in full under the temporary full expensing. There's a few rules as to when you can do this. For motor vehicles, there's a car limit. So if your motor vehicle costs more than $60,733, the amounts above that are non-deductible unless it's a specific type of vehicle that might be a ute that can carry a certain amount of tonnage. But in general, you can't go and buy a Ferrari and write it off on tax. That's the point. It's there is a car limit, but if you're buying assets for your business, you can write them off. So usually you depreciate those assets over a number of years. However, under the temporary full expensing, you can write them off. It used to be called the instant asset write-off. They've just changed the name. There used to be limits on the amount of asset. They've sort of got rid of those limits, except for motor vehicles and some specific assets. So as a practical example, you might purchase a car on the 23rd of June. The car might cost $50,000. You might finance the car, and you might have only paid a $600 installment in June. So you've just purchased a car, 100% business use. The profit in the company is $30,000. If you didn't purchase the asset, you'd have a $7,500 tax payable position using the 25% company tax rate. Under the temporary full expensing, we'd claim the GST on the vehicle if you're registered for GST. So if you're registered for GST, you'd get $4.5K refunded within your June quarter BAS. And we'd get to deduct the $45,454 asset expense, which is a motor vehicle. That would create a tax loss, right? Above, because you got 30K profit in the company, all of a sudden you're in 15K loss. You have no tax to pay. So you've reduced your tax to nil via writing off the asset. So that's really basic example of how it works. If you're buying assets prior to 30 June, you can write them off. There's a cap for motor vehicles. And there's also another thing which I'm going to run through now. They've created some tax loss carryback provisions. How this works is it ties in with the temporary full expensing. And what it's doing is it's encouraging new investment in assets, which may result in a tax loss. So it doesn't mean it has to have a tax loss. You might just buy an asset, expense it, and get some really good tax savings out of buying those assets. Or you might put your business in a loss, and if you've paid tax in prior years, you can get some of that tax refunded. Usually what happens is if you have a loss and you're a company, that loss just rolls forward to the next year. If you're a sole trader and you have a loss, if you passed some of the commerciality tests, you can offset that loss against other income. If you don't have any other income, that loss is quarantined and it rolls forward to the next year. So this tax loss carryback provisions are available to companies, public trusts, and corporate partnerships. What it basically means is if you make a loss in this year, but you paid tax in a prior year back to 2019, you can get some of that loss, obviously some of the tax paid previously refunded. So as a practical example, we used that motor vehicle purchase. It created a loss because the asset write-off exceeded the profit in the business, what we can do is we can look back, and if there was a profit made in prior years and tax paid, so as an example for this one, we're going to say that in 2020, there was a profit and there was tax paid in that year. That means we can use this loss for the current year and we can carry it back to the prior years to receive a tax refund because you've already paid tax in those prior years. So what that means is instead of just having a $15,000 loss that rolls forward to the next year and you can use it next year, you can actually get some of the tax that was paid previously refunded. So this is a new thing. They had it last year, but it's quite recent. It lasts until next financial year is the last year of it. And it's encouraging investment in assets particularly, and given COVID-19 and businesses were doing it tough and having losses, they were saying, well, because it's been quite challenging, we understand that you're forced to shut down for periods, we get it, there's some losses. We also want to stimulate some investment in assets. So to do this will allow you to carry back some of those losses to prior years and get some of that, the tax paid previously refunded back to sort of smooth your income. Superannuation, that's always a big one. So at the end of the financial year, super is a great way to reduce your taxable income and get an after-tax benefit. If you've got cash in your business, it's always good to have a runway of cash. You don't want to just, spend all your money in your business and leave no cash. So a good general rule of thumb is leaving a few months of expenses within your business at all times as a cash balance, just so you've got enough cash if you have a downturn or you lose a contract or if something goes wrong, you can cover your expenses for a period of time. So super is a great way to reduce your tax. The concessional cap has increased to $27,500, was previously $25,000. You can use prior year not utilized concessional contributions. They're big words, but basically what it means is in prior years, the cap was 25K. So you could put in 25K into your super and get a tax deduction on that 25K. If you put in 10K last year, you've got a 15K unused balance. Now that rolls forward for 5 years. And this sort of unused contributions started for the 2020 financial year. So you can go back a couple of years and you might have a bit of excess super you can put in and get a tax deduction. A couple of key things with super, you need to make sure it's paid prior to 30 June and it needs to leave your bank account and hit the super account. So it's important you give yourself enough time. So don't leave it to the 28th of June or the 30th of June and pay super, because it's likely that you might not get a tax deduction for that. If you've got wages, so if you've got employees, you'll probably have accrued superannuation for the June quarter, because you lodge your super on a quarterly basis, you pay on a quarterly basis. It's usually payable the 28th of the following month after the quarter. So super for the June quarter, usually due the 28th of July. If you pay it on the 28th of July, it's not deductible in the current financial year. So we say if you do have enough cash balance, bring forward the accrued super for the current quarter and pay it as soon as possible, given we're late into June, so that it's tax deductible in the current financial year. A key thing as well is super is increasing to 10.5%. So if you've got employees or you pay yourself out of the company a director fee or as an employee, it's important to note that super is increasing up to the 10.5% rate. I think it's targeted to keep increasing over time up to the 12%. A practical example, let's assume you've got 100K income, you decide to put in 20K into super. The tax benefit is going to be $3,900 after tax benefit. And how that works really simply is your marginal tax rate at 100K is 32.5 plus a 2% Medicare levy. So you're 34.5% tax. If we deduct the 20K off your taxable income, we're reducing your tax by 34.5% of the 20K. The super's tax going in at 15%. So basically what happens is we're getting the gap between the 34.5 and the 15%. So you're getting an after-tax return of 19.5%, right? So it's really attractive. So if you're looking at the stock market and trying to get a 19.5% return, risk-free essentially, providing that you're going to put that money into the stock market, it's a great return. It's a great thing to do. You get the tax benefit in your tax return when you lodge your tax return, so your tax refund will increase by the 3.9K. So super is a great way to minimize your tax. There's other strategies that we look at as well for contributions for partners and family members. If we've got family group structures, there's things we can do to minimize the group's tax position and get some super into the family accounts if there's that excess cash to utilize as well. So income splitting, this is probably the most common tax planning tool that we look to utilize. And it's basically just looking at what's the business's position. Is there any structuring that we can utilize to minimize tax? So is there a family trust? Is there a bucket company? Is there a spouse? Is there children? And can we spread the income across these entities to minimize the tax? So as we know, the individual tax rates go up to 49%, and there's opportunities at the lower income levels to minimize tax. There's things we can do with dividends and franking credits being refunded. There's limits on how much we can give to children. If they're under 18, it's capped at a really low amount. However, there's opportunities with the bucket company and spouse to minimize tax. We do need it structured correctly to do this. So it's a good time to look at your structure to work out, are you structured effectively to minimize your tax? Company tax is capped at 25% in the business, but if you've got a corporation, the key is always getting the money out of the business into your personal sort of family group. And what's the most tax effective way to do that? And usually it's done through a variation of ways, but it could include things like having the family trust as a shareholder, paying dividends to the trust, and then utilizing a bucket company and family members as the beneficiaries of the family trust. So income splitting is really useful. And if you've got a company structure, that's definitely the best way to, a company structure with a family trust is definitely the best way to utilize income splitting to reduce your tax at the end of the financial year. This one's pretty straightforward. They've increased the low to middle income tax offset. So I think you'll probably remember there was that 1080 tax offset the last couple of years. They've bumped it up to 1500 for this financial year. So if you sit within 48K to 90K taxable income, you'll get the full $1,500 tax offset. If you earn above the 90K, it basically gets minimized for every 3 cents for every dollar above the 90K, and it caps out at 126. So if you earn above 126K, you don't get this one. If you earn below 37K, you just get the 675. And if you earn between 37 and 48, again, you get some sort of 675 plus a percentage for every dollar above that, up to the 1500. So that's automatically calculated. You don't need to do anything. It just sits within your tax return. So nice and simple one. A really good tip for the end of the financial year is just to make sure your accounts are up to date and closed off. And I think it's really critical that you do live bookkeeping, so you've got a good position, a good sort of view of how your business is tracking. You really need your accounts up to date. So before we do tax planning with our clients, we really need their accounts closed off up to a particular point, whether that be the end of May or April, depending how early they want the advice. But we do need the accounts closed so that we can get an accurate picture of what the estimated tax positions are going to be. It also is really useful for budgeting forecasting, which I'll run through in a little bit. And it gives you a good picture of the business's financial position. So you can have a look at the balance sheet and sort of see how your business is positioned. What's the liquidity in your business? Do you have much cash on hand? How are you utilizing your cash? What are your liabilities looking like? Are your ATO obligations up to date? Are your taxes up to date? And also for structuring as well, it might provide insights into some really key structuring things that arise. So by having your accounts up to date and closed off at 30 June, that sort of sets you up for the new financial year. I'm sure a lot of you are doing it, but it's just really critical that you are closing off your accounts at the end of the financial year as soon as possible, so that you can go into the new financial year with a clean set of books that you can use for forecasting and budgeting, planning, decision making. A lot of the historical transactions will provide insights into future expected transactions. So it's important you have your books up to date so you can think a bit more strategically about sort of how your business is positioned. Working from home expenses, this is a common one. So everyone's sort of working from home now. There's occupancy costs and running costs. So occupancy costs are basically like rent. If you're renting, if you own the place, it's like interest repayments on the mortgage and basically property holding costs like council rates and water, etc. Running costs are more like the costs that you have that are sort of discretional, and like things could be like lighting, electricity, those sort of costs that you don't have to hold the property. It's more you choose to have. So that's the difference between the two. If you're running a business, usually you'd have, you could claim both, but you do need a dedicated sort of office area for that. And it does need to be done at some sort of floor percentage against the total square meterage of the property. So it's really important to have a basis for how you got to your percent to allocate. So if you've got interest repayments on a loan and you want to claim that within your business, you need to have a reasonable office area versus total floor area, so you can work out what the percent should be. So they're the two main ones. I suppose one really critical thing to think about is your principal place of residence implications. So if you own your own property and you're claiming your business, your occupancy costs through your business, you'll only be eligible for a partial main residence exemption. And what that means is usually your principal place of residence is capital gains tax free. So you don't pay tax if it goes up in value when you sell it. However, if you're claiming occupancy costs against your business income for that property, then the portion that the percent that you're using, that you're applying against those occupancy expenses, that percent is now taxable from a capital gains tax perspective. So when you're choosing whether you should claim occupancy costs, it's good to consider the capital gains tax implications in doing so. A key one is ensuring your tax obligations are up to date. So this one's pretty obvious, but it's just making sure that your BASs are up to date, your prior year lodgements are up to date. If you've got withholding taxes, just making sure everything's nice and clean and up to date. If you've got employees, making sure you've been doing the single touch payroll reporting, so you can close that off at the end of the financial year. But key things that can come from this is like a tax plan. So what we do with our clients is do a tax plan for some of those clients that wish to engage us for that. And it sets out what their estimated taxes are going to be for the next 12 months. This really helps when they're doing their budgeting and forecasting, because they get an understanding of what's the upcoming tax obligations that they need to think about. A lot of people, when doing budgeting and forecasting, leave out the taxes and just kind of run it as a operational forecast without including the actual tax obligations. So their cash position's never really accurate. So it's important to make sure you're putting in your tax and super obligations, so you've got an understanding of what your real and accurate expenses coming out of your business. It's also good to review your reporting periods and how you're reporting. So an accrual versus cash basis, you can look at that from a GST and income tax perspective. So for GST, if you've got a lot of invoices to customers and you're not getting paid for quite a long time, you probably want to be on a cash basis. So just making sure you have an understanding of why you're on accrual or cash, and it's probably a good time, the end of the financial year, to review that and make sure it's you're getting the most out of it and you're not having to pay tax before you get the money. And income tax as well, that's a really interesting one. So a lot of people just report for income tax on an accrual basis. However, you can also elect to go on a cash basis. Again, accrual is the invoice date and cash is when the cash physically gets paid. There's always a gap between the two. So it's important to make sure that you're on the right reporting basis so you're not having to pay tax before you receive money. And and ensuring your lodgements are up to date, because you're going to have late lodgement penalties and interest. And if you have a debt, just make sure you get on a payment plan with the ATO. They are pretty flexible to work with, but if you don't engage them and have a payment plan, you will get chased by them, and it also may affect your being a director. Now they're starting to look at ATO debt as a way to monitor credit ratings, which never used to happen. So it's interesting that's come up. So it's important to make sure you're on top of your ATO obligations and your ATO debts, because it might negatively impact your ability to get a loan in the future. So a key one is budgeting and forecasting. I know for our business, we run our business off a cash flow budget and forecast, and it just helps us plan, and it makes things really easy to understand what's coming up, and makes us really good with our capital allocations. So we understand where money's going and why. We use historical transactions to do it. It's really good to do it at the end of the financial year, because you've got, it's a good time to reset. You finish the financial year, you've probably got a rough idea of what's coming up for the next year. You can use the prior transactions, so the historical transactions, to somewhat predict the future. There's going to be a lot of transactions that are repeated or occurring that you can just pull out. And then for the ad hoc ones, you can just have a look at timing as to when they're probably going to come up. And I suppose the key is just reviewing some benchmark data as well from the ATO to see how you're positioned in line with the current market. So is your business doing okay? Planning for your tax payments is critical. So this will allow you to see when you're going to have those tax obligations coming up. We used it because we wanted to really see what our growth opportunities look like and whether we are using our cash flow effectively. And so with ours, we had a lot of drivers driving the revenue. So how do we get revenue into our business? How do we get leads into our business? What's the cost of getting those leads? What are the sources? And what if we allocate capital in certain ways? What would be the likely outcomes of doing so? That's a bit more detailed. You could do a really basic one just to get an idea to keep a track of your expenses, or you could go a bit deeper and just work out what are the drivers for your revenue and work out is your capital allocated efficiently to grow your business, and that could be in line with what are your business objectives. Is it profitability? Is it growth? And so you could create your forecast and budget to match to your objectives and where you want to get to. And it's also good to look at operational efficiencies, software and technology. So is there anything you should be doing to sort of automate things or reduce costs? Labor cost is a big one. So you can plan out hiring as well. So we have a separate tab for hiring. At what point do we hire and why? And who do we, at which level and department do we want to hire? So it's a good way of just planning out what's the next 6 to 12 months look like. And is there any ways to reduce your costs, increase efficiencies, and increase your growth? We review ours on a monthly basis, and it's really useful to just getting an understanding of where we're positioned, where we're heading, what's our key priorities, and is our sort of business working in a way that's moving towards our goals. Outsourcing's a big one. So currently in the market, we've got rising costs and inflation. And I suppose a really key thing is making sure that you've got a good grasp. Is your pricing set up in a way that can handle the current rise in costs, and will the rising costs affect your business much? So understanding what are your expenses, and is there likely to be some increases in those expenses? So it's a really good time to review your pricing to make sure that you're priced effectively with rising costs, and it's a good time to potentially increase your prices for the new financial year if you can. Obviously, you've got to look at the current market. Will you lose market share? What will happen? So if you don't have price sensitive customers, it's a bit easier, but if you do, then you should to really review that a lot more closely. But the cost of everything is rising. We definitely know that. And labor costs is rising as well. So outsourcing is a really useful tool to reduce your costs. And obviously, if you've got software development, admin, we've got accountants that we utilize as well offshore. So it's a great way to reduce your costs and make sure that you can sort of stay ahead in this sort of new world of inflation, rising interest rates, rising costs. Just making sure your business is keeping tabs of your expenses, so you're not going to be too negatively impacted from all these rising costs. And if you need a solution partner, we've partnered with Remote Hirely, so just click on the link and check them out. Cool. And obviously, it's a really good time to look into your advice, and with the current market conditions, it's a really good time to get an understanding of is there any levers you need to be pulling to stay ahead. And this is where this plan is really useful. So it's on-demand accounting and legal advice. You get 30-minute calls with expert lawyers and accountants, and there's no hourly fees. So if you wanted to pay for mine or Damon's time, or the accountants and lawyers' time that support us on an hourly basis, it is a lot more expensive. And if you were to go into the market and look at paying a lawyer, I'm sure you've dealt with a lawyer or accountant before, you're gonna pay a lot more per hour. Could even be useful for accountants on the call if you needed specific technical advice on certain things. It's always good to have that option there to get a second opinion as well. So look, it's a really good product. We've got really technical people that work on this product. And we find that businesses that engage on this product on a regular basis do a lot better than businesses that don't. And I think that just comes back to, in general, like a lot of clients we deal with, it's the ones that we engage with on a regular basis. They're the ones that by far do the best. The ones that we don't speak to, and then we do their stuff once a year, and they're always really late getting stuff to us, and they're hard to get. We'll send 4 or 5 follow-up emails to get an answer on a question. 100% the business is always never doing as well as the ones that are getting ongoing advice, are in touch with us, are engaging us, and utilizing our team's expertise. So yeah, really encourage you to try this out. I think we've got a 3-month trial, which is really exciting, and unlimited calls, and you can speak to expert accountants and lawyers, so it's really valuable. I'll let Angela jump in and just mention what we've got for people in attendance today.
Thank you, Pat. So as Pat mentioned, if you sign up today, you do get a 3-month trial of our legal and accounting advice plan for only $1.99 a month. So if you did want to take up this offer, you can just comment yes in the chat, and then one of our sales consultants will reach out to you after the webinar, and will make the process extremely easy for anyone who does want to join. So feel free to just say yes, or I'll send across the link if you guys just wanted to do that manually yourself. That's an option. But I think it's time for questions, and we've got some questions that have come through, really, really great ones. So Pat, cool. Ready when you are.
Yeah, let's go. I flew through it, which is good, and I hope I hope you got a bit of value out of that one. Yeah, looking forward. Shoot me some questions, and I'll see what I can do.
Okay, awesome. So the first one is, under section 100A, under the ATO radar, When distribution payout to beneficiary, how is the right way to get the money back to a trust as working capital for investment if that beneficiary has no management role in the trust?
Yeah, so I'll just give a bit of context around that. So that's basically the ATO came out and said if you're distributing from a family trust to a child, as an example, you do need to make that payment. So what used to happen previously is they never paid the child. So there'd be a distribution, there'd be some tax effectiveness because you'd reduce your tax because you're distributing to your child, but they don't really have, they don't get the cash for one. So the ATO said, no, we're not allowing this anymore. You have to pay the cash. And there's rules around gifting the money back. So there is rules around that. I'll take that offline and recommend that we chat about that separately because it is quite technical. It's a new ruling that's literally just came out, and they actually backdated it, which is really frustrating, and the whole industry is up in roar about it because you know, usually they grandfather things and they say, okay, up to this date, whatever happened previously will leave, and then anything going forward, this is a rule. Whereas this one's really interesting. They've gone back and backdated it, which is a lot of people don't think's fair because they were playing by the rules at that time. How to get the money back in? There's obviously a few ways to do that, so I recommend getting in touch for that separately. But yeah, but the common rule is they can't just gift the money back. So there does need to be a commercial way to get. There is ways that you can do it, but it needs to be done on a commercial basis. So it can't be a non-commercial gifting back in, because then you'd be in trouble again, and they'd say that you haven't satisfied that 100-day ruling.
Okay, awesome. I believe this question was in regards to slide 2. So they said, I'm assuming that the asset must be installed and ready for use by 30th of June to make the claim.
Exactly, yeah. So that's a good point to bring up. And yeah, so that's really important. So you do need to have the asset, and it does need to be ready to be used for it to be deductible. So if you want to write the asset off, you can't order an asset and not get it, and then you get it in September. You've got to have that asset. So that's a really key part of getting that temporary full expensing write-off.
Okay, awesome.
Thanks for sharing.
Next one is, if my name is in the ABN, can I claim all the expenses I put out to get qualifications, licenses, office equipment, vehicle going back a few years?
So the answer is what you should have done. Potentially the ABN buys those assets. In short, most likely there'll be, I'd probably need to see the transactions and the dates, but in short, did you have the ABN in prior years, and could you have put them as a loss in those prior years and carried that quarantine loss forward to offset in the current year? So I'd probably just need to see when the ABN was created. If the ABN was created now and you already had assets, we'd probably need to look at the written down value of those assets that the ABN was to get to deduct those. It's important if you're a sole trader to look at the personal services income rules, which is do you satisfy PSI? And that comes down to there's basically, you know, do you receive personal services income? If more than 50% of your sort of income is derived through your own effort and personal skills and labor, then you did receive personal services income. And then it goes through tests. There's a results test, there's an 80-20 test, and then there's a separate bunch of tests. So to deduct assets via different temporary write-off and things like that, you'd need to be operating as a small business. And to do that, you need to pass PSI. So if you're a sole trader and you're getting paid for your skill and labor, it's really important that you engage with a tax advisor and accountant to, one, see if you do have PSI and whether you pass the tests, and potentially how you can pass the test. So there's always things you can do to get around PSI, but you're going to obviously take certain steps to get there. So your deductibility of expenses depends on your personal services income tests. That's really critical thing to note. And then if you want to deduct expenses from a prior year, it would depend upon, if you had an ABN in prior years, I'd just recommend amending the years and putting the expenses under the ABN in those years and carrying them forward as a non-commercial loss, and that offset the current year income, providing, will that offset your sole trader income for this year? But if you didn't have the ABN, you could potentially bring them in, but there'd be probably a written down value for those assets.
Okay, awesome. Can I pay super if I'm aged 73?
Yes, you can if you're still working. So they just changed the rules for that one. They limited when you can contribute to super. And I believe if you're working, you can still contribute for that age concessionally, which is great. So if you're still working, you can do a concessional contribution to your super.
Okay, awesome.
If you do need your account, an accumulated super account to do so. So if you're in pension mode, which you could do, so if you're 65, you can have all your super in a pension account, which is tax-free. So that's fine. But if you want to contribute, you would need to create an accumulation phase account. And you can obviously have two. So you can have a pension account, an accumulation account. You can have most in the pension, but you do need some in an accumulation, can't even say it, an accumulation account so that you can contribute concessionally.
Okay, sweet. If a person had a TPD payout a few years ago and part of that super component was taxable, can a person claim some of that back or have it as a rollover in credit for a new business to start up?
Sorry, one more thing on the super, there is a minimum hours worked at that age. So you just need to make sure I think it's 10 hours a week. So I'll check that one, but you just do need to be working. This is a insurance payout, I'm assuming. Sorry, could you say that one once more?
Yep. If a person had a TPD payout a few years ago and part of that super component was taxable, can a person claim some of that back or have as a rollover in credit for a new business to start up?
Yeah, I'd need to look into this separately. It's really specific, but I believe, yeah, I'd need to look into it. Yeah, so I'd check that one, to be honest. My assumption would be if tax has been withheld, it's probably going to be included as income, and there's usually different tax caps for those types of payments. So if you earn a lot of other income, it doesn't mean it's going to get added and you're going to pay, say, as an example, 49% tax. There's tax caps on those types of payouts, but my gut feel is it's probably going to be included in a tax return and you'll get to use those withholding tax against the tax on it. But I'd need to look at the specific details of the transaction. So that's a bit too specific, sorry.
Do you know if the ATO's data matching program can detect some income paid through direct bank transfer for work done as a contractor with no ABN?
It's a good question. So basically the ATO has what the ATO now, if you pay contractors, if you're in a specific industry class, you need to report the income that you paid to the contractors. So you'd need to put down the amount you paid that ABN for the year. And then what it does is it does go into the ATO system and they can data match, and it shows up in your pre-filling reports now, ABN income. So if they're doing it properly, it comes up. If you don't have an ABN, it's really, what should happen is the company that pays the person that doesn't have an ABN should withhold at the highest marginal tax rate. It's called ABN, no ABN withholding. So you'd have to withhold 47%, pay that to the ATO, and that only get paid 53%. So if you got invoiced by a contractor and they didn't have an ABN, you'd need to withhold the highest marginal tax rate on that. In regards to data matching, I think if they don't have an ABN, there's no way of the ATO checking that unless they audited, because you need to put the ABN in the amount that would then show up as income for that person. So unless they're and they need to be in a specific industry. I'll give you an example. A builder that has contractors needs to report on an annual basis all the contractors and who they paid, but they need to have an ABN included in that. So if they don't have an ABN, they obviously can't put that person in. And if they don't have an ABN, they should have done the ABN withholding as well, the withholding tax. So yeah, probably no for the ATO data matching, but it's a bit of an interesting question.
Do you know how much a lifestyle assets data matching program with the ATO and income threshold limits, etc.?
Which one was that? Lifestyle?
Yeah, lifestyle assets.
No, I'm not sure if there's anything like that. There could be, but not to my knowledge.
Okay. What taxable income to have 70K car under lifestyle assets data matching program?
Yeah, I'm not too sure about that. I think just in general, yeah, if you've got a car and it's 70K, you can only deduct the 60K of that asset. If you register for GST, you'll get paid the GST on it and deduct the maximum you can deduct for a car is the 60K. But if you take the GST off, is the 54K. Sorry, I think my example had 45. It's 54K. Is the maximum. So I'll update that before we send the slides. But yeah, it's just there's a luxury car tax sort of thing as well. But yeah, they cap the amount you can deduct. I'm not sure about the data matching. Yeah, I'm not sure what that question's trying to work out. Are they saying they want to deduct 70K? And if will the ATO know? I'm not sure if that's what they're asking, but I'd recommend not doing that. Just not sure what they're asking.
Okay. If you're a company and you have affiliates attached to your business, how does this affect the company, or what is the best practice to minimize tax?
Yeah. What do they mean by affiliates? So associated businesses potentially, or are they individuals? Can they? Yeah, I'm just not sure what they mean by affiliates. Shareholders, they're talking about. Yeah, I think in general, there's probably just getting a bit more information regarding that. Ways to reduce tax: if you have entities within a wholly owned group, you can do a consolidated tax return, which means if one entity has a loss, the other entity has income, they can offset each other. Even if it's not 100% owned, you can do your portion of another entity within a group as well. So that's fine under consolidation. It's a bit technical, and if you bring entities into the group that have losses after, there's different calculations that reduce the losses as well. So it is quite technical, consolidation. You could invoice between entities as long as there's services performed for that, which could, if one entity's got a loss and the other entity's got income, you could do things like that. If there's individuals to utilize, you could work out if they've used their time and maybe you could pay them for that time. There's obviously a lot you can do if there's multiple entities involved, but again, you've got to understand what the position is of each entity and then work out what levers you can pull regarding invoicing and transferring money or director fees or different things. So you could do a consolidation. There's a lot you can do. It changes from business to business, and it does need to be commercial as well. If you're just going to invoice a separate entity, there's going to be a nexus from the invoice to what you're actually putting in that invoice, if that makes sense.
Okay, awesome. Can the beneficiary of a family trust withdraw surplus money before the end of financial year?
Yeah, good question. So family trusts, you can. Family trust, what happens in a family trust is they distribute out the income each year, and they don't keep money within the family trust to be taxed, which is because if they do, it gets taxed at 47%, the highest marginal tax rate. So if you have a family trust, you never keep the profits in there. So if there's profits to distribute, you never keep the profits in the family trust. Now, why I'm telling you that is, what it means is technically all the monies in the trust are sort of treated somewhat as after-tax monies, especially if you're doing distributions. So if there's money in the bank account in the trust, generally you can take it out without too much worries, but I'd definitely speak to your accountant just to make sure that's okay. 95% of the time, if you put money in a trust, you can take it out. That's totally fine.
Okay, awesome. Hi, Patrick. Thank you for the information. Do you know the status of the New South Wales export grant? It was supposed to be open from the 1st of July, but I think it's been postponed. Any idea when it might be opened?
I'd need to check into that. So we don't do export grants ourselves in-house. We've got a partner that does that. So I could connect you with them to get some information if you need it. Yeah, apologies. We don't do export grants, so I'm just not too sure.
How do I get access to benchmarks for similar businesses?
Yep, so there's ATO benchmark data. So if you just Google ATO benchmark information, there's some good information. There's also benchmarking data that's more granular, but you've got to pay for it. So if you just Google ATO benchmarking and industry, there's a lot of useful benchmarks which you can use. And like key ones are looking at labor as a percentage of revenue. They do have them for the size of business and industry. Example, say you're a plumber, you can look at a plumber that earns between X amount of income. What's the average income and expense? What's the average, expenses? And then you can sort of use percentages to gauge, are you in line with that? So what's your percentage of labor to income? What's your percentage of rent, things like that? Like retail rent's a really good one. So what's your return on your space and things like that? So ATO benchmark data is good, but there's also better benchmarking data, but you've got to pay for it. So if you just Google benchmarking, a bunch of stuff will come up, and you'll the ATO is a free one, and then anything else, I'm not sure, they might charge you, but they're more granular.
Okay, awesome. I need to run payroll again on the 27th of June, so I won't know my full super obligation for the quarter until then. Do you say that I can pay super for everything owed up so far this quarter?
Yes, yeah. So you could do it twice. So you could pay 2 installments. So you could do your accrued super and just do it now, and so it's done. And then the only downside to that is you may, with the clearinghouse, it doesn't let you process 2 transactions at once. Usually you need to wait for the existing one to clear before you can do another one. So just be mindful, if you do it now, what's accrued now. The key thing would be, are you going to top yourself up? And if you are, do it now and include it within this first run. Because if you do this first run and it doesn't clear for 4 days or so, and then you go to process the next one, might not clear in time for you to claim it. So definitely you can do it early, and a lot of our clients have been doing it early. We've done it for a number of clients already. But just important to note that if you do choose to do it in 2 transactions, you might not be able to get the second one.
Okay, awesome. Can unit trusts retain profit in trust and not distribute to unit holder beneficiaries? What is the tax consequences?
Yeah, so unit trusts are sort of treated like companies. Bit different to a family trust or a discretionary trust, where you get taxed up to that sort of 47% mark. So unit trusts are treated like companies, very similar. So I think you'd probably be looking at the 30% tax rate if you retain profits. You'd also look at why you're retaining profits and not distributing. You could distribute and put the money back in as a loan, which is then obviously you can get that refunded. You might buy additional units. And for certain, if you've got a loan against the units, you might need to get a distribution for interest deduction. So a lot more complicated than it sounds, but in general, you can keep the profits in a unit trust, and they can be taxed in a unit trust at a similar rate to a company.
Okay, awesome. We'll just get through 2 more questions before we finish up the webinar. So if you are set up under a corporate trust structure with a family trust associated, do you have to fully distribute all income, or can you accrue percentage of income for forecasted expenses for the next financial year? For example, expected marketing spend. Are there any limitations?
Yeah, so pretty simple. Like family trust has a profit and loss for the year. Whatever the profit is, you do need to distribute that out to the beneficiaries. If it's a discretionary family trust, you can choose who gets what income. You do need to do a trustee resolution prior to 30 June. It's really important that you document, what percent of the distribution or the amount of the distribution that the beneficiaries are to receive. So if you've got a family trust or a discretionary trust, you need to prepare this internal document that says who's going to get what. Because you might not know the proper income, you can always do a percent. So I'm going to give these individuals these percent. I'm going to give a bucket company this percent. But you need a trustee resolution done. You do need to distribute. You don't need to, but why would you keep it all in there to get taxed at 47%? So you'd want to distribute it all out. And obviously if it's a distribution to individuals, you can, it depends. This comes back to the 100A, which you probably should get some advice on. So you used to be able to just keep all the money in the trust. It'd be like a book entry. You wouldn't actually pay the distribution, and then you just reinvest the money in the trust, and you just have these sort of beneficiary accounts accruing unpaid present entitlements. So they're just accruing money owed. But the ATO's changed some rules. So it's important to get some tax advice around distributing from a family trust each year, just so you know what you should and shouldn't do. If the corporate trustee, if you're going to distribute to one person, there's probably no issues with keeping the money in the trust and paying marketing expenses, but there'd be a tax, there'd be an income distribution if there's a profit to an individual that they'd record in their tax return if you choose to distribute to them. If it's a family trust and it makes a loss, it's really important to note that losses are trapped in a trust. So if you've got losses, there's not much you can do. They just sort of stay there until you make a profit. So they can't utilize income. You can't distribute a loss out of a trust. So the loss is, say, trapped in the trust. It's only if you've got a profit. Obviously, if you've got income in the trust, sure, you could use marketing expenses for next year for the cash, but you've got to do the distribution for this current year and distribute to the beneficiaries from a book perspective. Under 100A, the new ruling, they're saying if it's the people that don't have sort of that control over the trust, you should be paying, especially children, you should be paying the distributions, and there's rules around them gifting the money back. So definitely get some advice for that.
Okay, awesome. Okay, so last question, guys. So superannuation changed to 10.5% from the 1st of July. Does that mean from April to June 2022 quarter, as it is not due until 28th of July, if it is paid after the 1st of July, then we have to adjust it to 10.5 for April to June 2022 quarter?
Yeah, good question. It's just 10% up till June. And then from 1 July, any payroll reported will be at the 10.5%. And your accounting software should be automatically picking up the superannuation. So you'll see in your accounting software, if you did a pay run, which you should use your accounting software for single touch payroll, you do need to report your pay slips within 7 days of preparing your pay run. And yeah, so basically the accounting software will deal with it. You might not notice it much, but there'll be a slight increase in the super. I'm sure your employees might see it in their pay slips. And if you're paying director fees for yourself and those sort of things, you do need super withheld on director fees and things like that. So yeah, your accounting software will pick it up till 30 June, 10%, from 30 June, 10.5%. So you shouldn't need to do anything. Your super accrued and payable within your accounting software should automatically be at that 10% up to 30 June.
Okay, awesome. That's it for today, guys. Thank you so much for joining us. Thank you so much, Pat, for taking out your time to answer all these very technical questions.
Thanks for having me.
You're very welcome. So for those who are wondering, we do record the webinar and we will send a copy of the slides to your email. And we have many other webinars coming up. So if you guys just have a look at our social media pages, we constantly update it there. And this will be uploaded to our YouTube account as well. So if you did want to access it, you can access it from there as well. But that's it for today. We hope that we've answered your questions. And good luck before the end of financial year. So have a great day, everyone.
Yeah, thanks. All the best for the new financial year. Thanks for joining.